If you walk into that exam and see a country with double-digit growth, a booming stock market, and a government promising the moon, bring your own telescope. Look for the hidden debt in state-owned enterprises that doesn't show up on the sovereign balance sheet. If the government's growth story relies on building bridges to nowhere, that boom is just a prelude to a bust. Never confuse a country's marketing department with its actual economic reality. Look for independent data, trust your framework, and always, check if you can actually get your money out of the country before you put it in. Let's go.
Doc, quick question. Imagine you're betting on a friend's startup in a volatile, brand new country. What's the single biggest silent killer that ruins your return before you even see a profit?
James, that's an excellent starting point for our analysis. The most dangerous silent killer is often the combination of weak property rights and the inability to enforce contracts. If the legal system doesn't protect your claim, you have no true recourse when things go wrong. We call this willingness to pay risk, which is fundamentally different from the economic ability to pay risk. If a government chooses to disregard legal obligations or confiscates assets, your economic models won't save you. You must evaluate if the political and legal institutions are stable, legitimate, and subject to real checks and balances.
Got it. So ability is if they have the cash, and willingness is if they actually feel like giving it to me. It sounds like investing in these markets is like trying to hold onto a bar of soap in a shower. The harder you squeeze, the faster it slips away.
That is a vivid, if slightly messy, analogy. Analytically, we segment these risks into economic and political/legal categories. When we talk about the ability to pay, we are looking at macro fundamentals that make a country vulnerable to distress. Emerging markets often suffer from concentrated wealth, a limited tax base, and heavy reliance on cyclical industries like commodities. If a country depends entirely on, say, copper exports, any dip in global prices shatters their ability to meet debt obligations. Furthermore, poor fiscal control and reliance on foreign debt, especially in hard currencies, exacerbate this vulnerability tremendously.
So if they're borrowing in a currency they don't print, they're essentially playing Russian roulette with the exchange rate, right? One bad devaluation and their debt load explodes compared to their actual tax revenue.
Precisely. That is why the ratio of fiscal deficit to GDP is the most closely watched metric by analysts. If that fiscal deficit ratio persistently stays above 4%, it is a major red flag indicating poor discipline. Additionally, we must monitor the debt to GDP ratio. While 70% or 80% might be manageable for a developed nation, it indicates severe vulnerability for an emerging market. You must also check if foreign exchange reserves cover short-term debt. A ratio under 100% is extremely risky. We want to see reserves closer to 200% to ensure the country has a safety buffer.
Wait, so if I see a country with a 5% deficit and debt piling up faster than their GDP, I should basically run for the hills, even if the growth rate looks decent? Is growth just a mask for structural rot?
You are thinking like a true analyst. Growth can indeed be deceptive. If an emerging market shows a persistent real growth rate of less than 4%, it isn't catching up to advanced economies, it's falling behind. This stagnation creates immense political stress, which directly threatens your investment. When you evaluate these economies, you must look at the track record. Has this sovereign defaulted before? How did they resolve past crises? Past behavior is not a perfect guide, but it is the most reliable signal we have regarding future fiscal discipline.
I'm picturing an emerging market as a high-performance car with no brakes. It looks fast, but it's eventually going to hit a wall, and the government is sitting in the driver's seat ignoring the warning lights.
That is a very apt visualization. We must also consider external support mechanisms like the IMF or the World Bank. An analyst should explicitly determine if a country has access to these agencies, as they can act as a lender of last resort. However, relying on bailouts is a dangerous investment strategy. We need to distinguish between countries with healthy fundamentals and those just riding a cycle of debt. Always remember that emerging markets are a heterogeneous group. Never apply a one-size-fits-all approach to your analysis.
So we've covered the ability to pay and that willingness factor. But what about the actual price tag? How do we calculate the risk premium for these markets without just guessing at a number?
Excellent transition. To quantify this risk, we often turn to the Singer-Terhaar model. This framework is vital because it separates a market's risk premium into two distinct components, a global risk premium and a localized risk premium. We first calculate the equity risk premium for a fully integrated global market. Then we account for the fact that these markets might be segmented, meaning they don't move perfectly with the rest of the world. The model explicitly adjusts for the lack of global correlation, which is why it is so popular for CFA candidates to master.
Hold on, segmented is like saying the market is on a desert island while the rest of the world is at a party, right? They don't hear the music, so they react to their own local drums instead?
Precisely, a desert island is a perfect analogy for market segmentation. If a market is perfectly segmented, it only reacts to its own local risks. If it is fully integrated, it reacts only to global systematic risk. The Singer-Terhaar framework allows us to blend these two states based on how integrated we believe the market to be. We take the global market risk premium and multiply it by the asset's beta, then add the local risk premium, scaled by the market's specific correlation with the global index. This mathematical weighting ensures we don't double count risks that are already captured in global indices.
If I'm an examiner looking at this, what's the trap here? Do they want me to just plug in numbers, or is there a conceptual gotcha that trips people up?
The gotcha is usually about the correlation assumption. Many candidates blindly assume that emerging markets have a correlation of 1.0 with the world. They forget that the Singer-Terhaar model relies on the Sha-P ratio of the global market as a baseline. If you are asked to justify the risk premium, you must explain that the total risk premium is the weighted average of the fully integrated premium and the fully segmented premium. If the market is 70% integrated, you apply 70% to the global style premium and 30% to the segmented style premium. Ignoring that weighting is the most common mistake students make on the exam.
Okay, that makes sense. It's like a slider bar where we adjust for how much the country is plugged into the global grid. What about the Grinold-Kroner model? Does that just throw more variables into the blender?
The Grinold-Kroner model is actually a much more granular way to forecast equity returns. It breaks down the expected return into three specific components: dividend yield, expected earnings growth, and the change in the valuation multiple. We use this to build an expected return from the ground up, rather than relying on past performance. It is a powerful tool because it forces us to be honest about whether we expect the market to get more expensive or cheaper. If you expect the price-to-earnings ratio to expand, that adds to your total expected return.
So it's essentially the total return recipe. The cash I get from dividends, the growth of the company, and the fizz from investors getting more excited about the stock. But if that fizz, the PE ratio, shrinks, it can eat my whole return, right?
Exactly. That PE ratio contraction is the most volatile part of the equation. If you are asked to formulate the return, you must account for the share repurchases as well. Remember, earnings growth can be diluted by new share issuance or enhanced by share buybacks. The formula takes the dividend yield, adds the earnings growth rate, and adds a percentage change in the share base. Finally, you adjust for the projected change in the PE ratio multiple. If you miss that PE ratio adjustment, your long-term return projection will be mathematically incomplete.
This sounds like a lot of moving parts. Are we supposed to just guess the future PE ratio? Or is there a specific way to justify that fizz factor for the exam?
We don't guess, we evaluate the justification based on fundamental trends. For the exam, if you are asked to justify a PE ratio change, look at inflation and corporate transparency. Lower inflation often justifies a higher PE ratio because it lowers the discount rate applied to future cash flows. If the country is improving its accounting standards, that reduces the uncertainty discount and justifies a higher multiple. You must connect the valuation change to the underlying macroeconomic improvement. If the country remains opaque, do not justify a multiple expansion, regardless of growth.
So, to be crystal clear, if I'm in an exam hall and the prompt says, justify the valuation, I'm not just making up a reason. I am linking it to something like, say, a new law that forces companies to open their books, right?
That is exactly right. You are looking for a structural improvement that lowers the 19 risk premium or uncertainty in the market. Think of it like this. If a company starts publishing audited statements according to global standards, the risk of hidden losses drops. That transparency allows investors to pay more for the same dollar of earnings. Therefore, a higher PE ratio multiple is analytically justified by that specific measurable change in corporate governance.
I love that. It's like the transparency premium. Now let's pivot to the country risk rating models. Are these just fancy spreadsheets, or is there a specific reliable way to score a country?
They are indeed structured models. We typically use the weighted average approach, where we assign scores to categories like fiscal balance, political stability, and external debt. Each category receives a weight based on its importance to default risk. A crucial point for the exam is that these models are inherently backward-looking. They rely on historical data that might not predict a black swan or a sudden regime change. You must always supplement the quantitative score with a qualitative assessment of the current political environment.
So if the spreadsheet says AA because the history is great, but the streets are currently protesting for a new government, the spreadsheet is basically worthless? How do I flag that to the examiner?
That is the key. In your answer, you should determine the score using the model, but then justify a potential adjustment for qualitative factors. If political instability is high, you must argue for a risk premium hike, even if the quantitative model looks stable. The examiners want to see that you understand the limitations of the model. Never blindly follow a quantitative score if the qualitative narrative contradicts the data.
That's a classic level 3 move. Knowing when to trust the math and when to trust your gut. What about the debt restructuring part? That's always the messiest part of emerging markets, isn't it?
Restructuring is indeed the ultimate failed scenario. When a country cannot pay, it engages with creditors to negotiate a haircut on the debt. As an analyst, you need to calculate the recovery value of the bonds. The exam will test your ability to understand the difference between a voluntary exchange and a coerced restructuring. A voluntary exchange usually happens when the government tries to avoid default, while a coerced one is practically an act of default.
So a haircut is basically the bank telling the country, fine, just give me 60 cents on the dollar so I don't lose everything. Is there a way to calculate that impact on my portfolio?
Yes, and it is vital for your risk assessment. To calculate the impact, you must compare the present value of the old bond's cash flows to the present value of the new, restructured bond. The difference is your economic loss, the haircut. If the market is efficient, the bond price should have already dropped to reflect this expected loss. If you think the haircut will be deeper than what the market is pricing, you should underweight that sovereign debt immediately.
Got it. So it's all about the delta between what the market expects and what the reality of the country's balance sheet is. Are we through the woods on the fixed income side, or is there one more booby trap?
There is one more critical concept, the transfer risk. This occurs when a government imposes capital controls, preventing investors from moving their money out of the country. Even if a company is profitable and has the cash to pay you, the government might block the currency conversion. This effectively turns a solvent investment into an illiquid trap. You must analyze the central bank's foreign exchange policy, not just a company's balance sheet.
Transfer risk is essentially being locked in a burning building and finding the exit doors chained shut. The company inside is doing just fine, but I can't get my money out, so the liquidity is a total mirage.
A grim but accurate metaphor. To assess this, we look for Thai capital account restrictions. On the exam, if they ask you to evaluate sovereign risk, you must check for these barriers. A government desperate for foreign currency often freezes outgoing transfers to prevent a currency collapse. This isn't just a hypothetical, it's a standard move in emerging market playbooks. You must always consider if the country has a history of restricting capital flow, as that changes your entire risk profile.
So we've talked about the ability to pay, the willingness to pay, the pricing through Singer-Terhaar, and the trap of transfer risk. Are we ready to talk about the actual forecasting of equity returns in these spots?
Indeed, we are. Moving into equity forecasting, we often use the Fed model as a starting point, though it is fundamentally flawed. The Fed model assumes that the earnings yield of a market should be equal to the yield on a government bond. It's a very simplistic comparison, but the exam frequently uses it to test your ability to spot its limitations. It ignores the equity risk premium entirely, which is the extra return you demand for taking on stock market volatility.
That sounds like comparing a high-speed train to a bicycle just because they both have wheels. If I'm at the exam, how do I correctly dismantle this Fed model if they ask me about it?
You dismantle it by pointing out that it fails to account for the risk premium. If the Fed model suggests stocks are cheap because earnings yields are high, it's ignoring that you need a massive risk premium for that volatility. A justified question here requires you to explain that the earnings yield should always be higher than the government bond yield. You must argue that the difference between these two is the equity risk premium, which is a required compensation for systematic risk.
So the math is basically equity yield minus bond yield equals the I am taking more risk premium. If that premium is tiny, the stocks are overpriced, regardless of what the Fed model says.
Exactly. And this leads us to the synchronicity application for equities as well. We build the return by starting with the global risk premium and adjusting it for the specific market's Sharpe ratio and correlation. Remember, if a market is highly correlated with the world, the global part of the equation dominates. If it is isolated, the local risk premium, the reward for bearing domestic specific instability, becomes the primary driver of your expected return.
This is a great GPS check. We've covered the debt side, the traps like transfer risk, and now we're building equity expectations by weighting global versus local factors. What is the biggest gotcha when forecasting these equity returns?
The biggest trap is earnings momentum bias. Many analysts see historical high growth in an emerging market and linearly extrapolate that into the future. You must determine if that growth is sustainable. Look for structural drivers like a rising middle class or better infrastructure rather than just a transient commodity price boom. If the growth is purely cyclical, you must discount your long-term forecasts heavily, or you will overpay for temporary earnings.
So don't mistake a lucky strike for a gold mine. If I'm looking at a 10% growth rate, I need to ask myself, is this happening because the country is actually getting smarter, or because they just happen to find more copper in the ground?
That is the perfect analytical mindset. You have to be a detective, not just a spreadsheet jockey. You must evaluate the quality of the earnings growth. If it is driven by leverage, it will collapse when credit tightens. If it is driven by increased productivity, it is likely sustainable. In your exam response, always explicitly mention productivity as the true anchor of long-term equity growth.
Doc, what about currency risk in these markets? Is it just the dollar gets strong, my investment dies? Or is there something more technical I need to watch for in the exam?
It is far more complex. We must differentiate between nominal exchange rate fluctuations and real exchange rate movements. If a country has high inflation relative to the rest of the world, its currency must depreciate to maintain purchasing power parity. This is a vital exam concept. If you ignore inflation differentials, you will systematically overestimate the return on your emerging market assets. Always use an international Fisher effect logic. Higher nominal interest rates are usually just compensation for anticipated currency depreciation.
So if I see a country offering a massive 15% interest rate, I shouldn't just grab it like a kid in a candy shop? I need to ask if the currency is going to tank by 10% next year, effectively eating my gains?
Precisely, and that is a brilliant way to phrase it. Analysts call this real carry. You take the nominal yield and subtract the expected inflation differential. If the result is positive, you have a real return buffer. If it is negative, you are essentially paying for the privilege of holding that currency. On the exam, when you are asked to evaluate a currency-denominated bond, always perform this mental calculation. It instantly separates the amateur from the professional.
That makes so much sense. It's like buying a boat. The sticker price is one thing, but the maintenance cost to keep it from sinking is what really matters. Is there any way to hedge this, or is it just the cost of doing business?
You can hedge, but hedging is incredibly expensive in emerging markets. Often, the forward exchange rates are heavily skewed against the investor because the market expects a devaluation. You must determine if the cost of the hedge, the forward premium or discount, wipes out the yield advantage. If you are forced to pay a 5% premium to hedge your exposure and your yield advantage over a safe bond is only 3%, you are losing money on the hedge alone.
So the hedge can actually be the trap. You think you're safe, but you're just bleeding cash to the bank to protect a position that was barely profitable to begin with. How does the exam want me to show that I understand this trade-off?
They want you to demonstrate calculated decision-making. If the prompt asks you to recommend an investment, you must compare the unhedged return against the hedged return. If hedging destroys the risk premium, you must explicitly state that the investor should accept the currency risk or avoid the asset entirely. Do not just recommend a hedge because it seems safer. Demonstrate that you have quantified the cost of that safety.
I love that. It's all about the math of the cost. Let's talk about liquidity risk. How hard is it to actually get out of these positions when the market starts to panic?
Liquidity risk is often the most underestimated factor until a crisis hits. In emerging markets, the bid-ask spread can widen dramatically during periods of stress. You might think you can sell your bonds at a 1% cost, but in a panic, that spread might jump to 10% or even 20%. This is what we call liquidity-adjusted return. You must apply a discount to your exit valuation to account for the potential inability to sell at fair market price.
So it's like being in a crowded theater where the exit doors are tiny. It's fine when everyone is sitting down, but the moment a fire alarm rings, nobody can get out without getting crushed. How do I justify a liquidity discount on an exam?
You justify it by referencing the market depth. If the daily trading volume is low, you must argue that the bond is illiquid. For the exam, if you are asked to determine the fair value of an illiquid asset, you should incorporate a liquidity risk premium. This is simply an extra percentage point of return you demand for the privilege of holding something that you might not be able to sell when you need to most.
Doc, let's switch gears. We talked about liquidity and the exit door problem. How does the country risk premium (CRP) tie into all this? Is it just a flat tax I add to my returns, or is it dynamic?
The country risk premium is incredibly dynamic. It represents the additional yield required for the sovereign risk of a specific country compared to a risk-free benchmark like US Treasuries. The most common way to estimate this is the spread method. Looking at the difference between the yield on a dollar-denominated bond of the emerging market and the yield of a US Treasury bond with a similar duration. This spread tells you exactly what the market charges for that country's specific default risk.
So if I can buy a 10-year Treasury at 4% and a 10-year bond from that emerging market at 9%, the market is essentially telling me the country risk premium is 5%? That's the fee for the potential volatility.
Correct. However, you must adjust that 5% spread to make it an equity risk premium. Bonds and equities are different. Equity holders are last in line if things go south. We multiply the bond spread by the ratio of the annualized standard deviation of the equity market to the annualized standard deviation of the sovereign bond market. This captures the fact that stocks are significantly more volatile than bonds in the same country. You cannot just use the bond spread as an equity premium. That would severely underestimate your risk.
That's a classic trap. So the equity risk is effectively magnified because the stock is more jumpy than the bond. If the stock is twice as volatile as the bond, I should essentially be doubling that spread, right?
You are thinking mathematically, and that is vital. On the exam, if they ask you to estimate the equity risk premium, they will provide the bond spread and the standard deviations. You must perform that ratio calculation. If the equity market has a standard deviation of 30% and the bond market has 15%, the volatility ratio is 2. Multiplying your 5% bond spread by 2 gives you a 10% country risk premium for equities. Failing to include that volatility scalar is a surefire way to lose points.
This is a great GPS check. We've built the return model. We've analyzed the sovereign versus equity premium, and we've looked at the currency and liquidity traps. Is there anything about investor behavior I need to know?
Investor behavior is often the final piece of the puzzle. We observe a home bias where investors over-allocate to their own domestic markets despite the clear benefits of diversification. In the context of emerging markets, this bias is often amplified by a lack of familiarity or information asymmetry. Investors tend to feel safer in markets they understand, even if those markets are objectively riskier. For the exam, recognize that this behavior is a psychological hurdle that prevents optimal portfolio construction.
So investors are basically like people who only eat at the same 3 restaurants because they're safe. even if the food across town is better and cheaper. How does this impact the emerging market allocation?
It keeps capital from flowing to where it is most needed, which creates nice mispricing opportunities. For an analytical investor, this is a signal. If a country is sound but ignored because of information asymmetry, that is where you find the best alpha or excess return. You must evaluate if the market is being ignored due to real fundamental risk or just a lack of analyst coverage. The latter is an opportunity to generate significant returns for your portfolio.
That is the secret sauce, finding the hidden gem while everyone else is scared of the dark. What's the final justification piece for this module?
The final piece is integration. You must be able to justify why an emerging market belongs in a global portfolio. It's not just about higher returns, it's about correlation. If the emerging market moves differently than the rest of your assets, it reduces your total portfolio risk. Even if the individual volatility is high, the portfolio level benefit can be immense. Always focus on the diversification benefit, not just the return potential.
So if I'm in the exam and I see a company that looks like a bargain because everyone is scared of its country, I should ask, is this just fear-based bias? Or is there a genuine structural risk here?
That is exactly the question you must ask. You are looking for the gap between perceived risk and actual risk. If you can justify that the fundamental risk is manageable, perhaps because the company has hard currency revenue that offsets local currency devaluation, then you have found a superior investment opportunity. Always prioritize the cash flow analysis over the country's sentiment score.
Doc, let's wrap this up. We've gone from the macro, silent killers of emerging markets like property rights, down to the granular math of equity risk premiums and liquidity discounts. If a candidate had to remember only 3 things for the exam, what should they be?
If I had to synthesize the entire module into 3 pillars for success, it would be these. First, distinguish between the ability and the willingness to pay. They are independent variables that both require rigorous assessment. Second, never blindly apply models. Adjust for local correlations and specific risks, like transfer constraints. Third, always justify your forecast by citing structural drivers, like productivity or transparency, rather than just linear growth.
And one final piece of advice for the exam day itself? When they throw a curveball scenario at me, how do I keep my cool and stay analytical?
You stay analytical by following the framework first rule. Do not start by calculating numbers. Start by identifying the specific risk, whether it is currency, political, or liquidity, and explain the why before you touch your calculator. If you explain the mechanism correctly, the math becomes a simple confirmation of your logic. Examiners want to see your thinking more than they want to see your arithmetic. Trust your framework, stay calm, and look for the structural truth behind every prompt. Remember, emerging markets are not just risks to be avoided, they are environments that require a higher standard of due diligence.
You are taking the right step to master the frameworks, respect the complexity, and you will navigate these questions with the precision of an expert. Good luck with your final preparation.
You've reached the end of the line, candidate. Remember, in the world of emerging markets, the loudest stories are often the most dangerous. Don't chase the hype, chase the data. If the math doesn't account for the willingness to pay, the hidden cost of hedging, and the real-world risk of liquidity, then you aren't investing, you're gambling. Master these frameworks, keep your analytical edge sharp, and remember that on exam day, it's not about finding the winning stock, it's about surviving the trap. Class dismissed.